Hello everyone, welcome back to the channel. In these videos, we are going deeper into a very practical topic, how to apply tax treaty benefits in Indonesia under PMK 112 of 2025. This is not just theory, I will guide you step by step on what documents you need, how to prepare them, and how to avoid common mistakes. So, if you are dealing with cross-border transactions, make sure you watch until the end. Now let's begin with the simple situations. Your company in Indonesia is making a payment with a foreign party. This could be dividends, royalties, interest, or service fees. Normally, Indonesia imposes withholding tax on these payments. However, if there is a tax treaty between Indonesia and the recipient country, you may be able to apply a lower tax rate. But here's the key point. You cannot automatically apply the treaty rate. You must prove eligibility, and this is where PMK 112-2025 become very important. Now, let's go to the core part, required documents. Under PMK 112-2025, there are three main layers of documentations. One, certificate of domicile, or we call it COD. This is your primary documentations. The certificate of domicile proves that the foreign taxpayer is a tax resident in the treaty partner country. In Indonesia, this is usually submitted using Form DGT1 for corporate income tax and Form DGT2 for personal income tax. Now, let's break down the requirements. First, it must be issued or validated by the foreign tax authority. Second, it must cover the relevant tax period. Third, the information must match the actual recipient of income. Fourth, it must be signed, stamped, or electronically validated. Common mistakes include expired COD, mismatch in entity name, using a COD from a different group company, missing validations from the tax authority. If any of this happen, the Indonesian tax authority may reject the treaty benefit. 2. Beneficial ownership declarations. This is where PMK 112 becomes stricter. The foreign recipient must prove that they are the beneficial owner of the income. So, what does this mean in practice? The entity must have control over the income, not be legally or contractually required to pass the income to another party, bear economic risk, have a real business purpose. Usually, these declarations is included in the DGT form. But in many cases, especially for complex structures, you should prepare additional supporting explanations. For example, a statement letter confirming beneficial ownership, explanations of business activities, group structure overview. Why is this important? Because if the entity is considered a conduit company, the tax authority can deny treaty benefits, even if you have a valid COD. 3. Supporting documents for economic substance. This is the most underestimated part. The MK 112 clearly reflects a shift towards substance over forms. This means submitting forms alone is not enough. You must prove that the transaction is real and commercially valid. Here are examples of supporting documents. A. Transaction documents, contract or agreement, invoice, proof of payment. B. Corporate documents, article of association, organizational structure, shareholding structure. C. Financial and operational evidence, financial statements, proof of office, lease agreement or address, employee data, business licenses. These documents help answer one key question: is this entity genuinely conducting business or just used to obtain tax benefits? Now, let's move to the step-by-step process. Step 1. Identify eligibility. Before anything else, check, is there a tax treaty between Indonesia and the foreign country? What type of income is being paid? What is the applicable treaty rate? This step is often overlooked but very important. Step 2. Collect document before the payment. This is very critical. Under PMK 112, documents must be available at the time of withholding. If you collect them after payment, it may already be too late. Step 3. Review document completeness. You should verify for COD, valid period, correct name, proper authorizations, and for beneficial ownership, logical structure, no indications of conduit arrangement. For supporting documents, consistency with transactions, commercial rationale. Step 4. Apply treaty rate. If all requirements are fulfilled, the Indonesian payer can apply reduced withholding tax rate or even exemption depending on the treaty. Step 5. Documentations and record keeping. All documents must be stored properly. Why? Because during a tax audit, the Indonesian Tax Authority may request original documents, supporting evidence, explanations of transaction structure. If you can't provide them, treaty benefits may be reversed. Now, let's discuss common risks and mistakes. Mistake 1. Relying only on COD. Many taxpayers think COD is enough. It is not. Mistake 2. Using nominee or conduit structures. Even if legally valid, they may fail the beneficial ownership test. Mistake 3. Let document collections. Documents must be ready before withholdings. Mistake 4. Inconsistent data. Different names, addresses, or countries across documents can trigger rejections. Now, what are the consequences of non-compliance? If treaty benefits are denied, you must apply domestic tax rate. There may be tax underpayment, administrative penalties, and interest may apply. This can significantly increase the cost of cross-border transactions. Final practical checklist. Before applying tax treaty benefits, always ask, do we have a valid certificate of domicile? Is the beneficial owner clearly identified? Do we have sufficient supporting documents? Are all documents consistent and complete? Are we ready for a tax audit? If all answers are yes, then you are in a strong compliance position. In conclusion, PMK 112 of 2025 transforms the tax treaty applications in Indonesia from a form-based approach into a substance-based approach. This means it's not just about submitting documents, it's about proving that your transactions is legitimate, structured properly, and compliant with international tax principles. Thank you for watching. If you find this video helpful, don't forget to like, share, subscribe for more practical tax insights. See you in the next video.